Hi everyone, and thanks for joining us today for this Dynamics GP spring cleaning session. Time to declutter and clean up your Dynamics GP. My name is John Smith. I'm Director of Enterprise Business Solutions here at Corporate Renaissance Group. I have been working with Dynamics GP since 2001 at the time as a client, and I joined the consulting ranks in 2003. I lead our ERP practice here and have been involved in all sorts of implementations, business transformation projects, and definitely all sorts of Dynamics GP cleanup exercises. So pleased to take you through this today, and I'm going to share as much of my experience with these types of projects as I can as we go through the material. So just a little bit about us before we get started. Corporate Renaissance Group was established 27 years ago in 1989. We do have global offices and have been a trusted and remain a trusted Dynamics partner with an active reseller practice here, as well as a third-party software vendor. We really established ourselves a while ago with a product called Changer and continue to work with the Dynamics channel, offering various third-party products to help improve the efficiencies within Dynamics GP. What we do, again, reseller of Microsoft solutions. We also have a management consulting practice, and we have a software development aspect to our business as well. What we deliver, of course, Dynamics expertise, the add-on solutions for Microsoft Dynamics GP that we're going to talk about today. We also have an employee performance management software that's exclusive to Dynamics GP in terms of being able to integrate to it. It's called mPerform. We have a product for CRM called Trend Miner, and we support and implement budgeting and costing solutions with both Board and Adaptive Insights. In terms of agenda, what we're going to cover today is, well, let's start with just some of the stuff you guys already know. How does GP get messy and what can be done? And we'll kind of talk about what I've seen there over the years, and I'm sure I won't capture all of it, but some of the big things. But more importantly, we'll focus on how to clean it up and how to fix it, and some things to keep in mind. And during that, we'll give you a good perspective into the tools that are available to assist as well. So how does it get messy? Well, you probably know from using GP, it's probably why you're attending this webinar, that some of these things may come up. So we have things here like too many GL accounts. We see that all the time. We work with clients that have let their Dynamics GP databases grow. In one case, I worked with a client that had over 200,000 general ledger accounts before we did a cleanup on it. At that level, at that time, it was 5, 6, 7 years ago, it was causing posting to take, when you click the post button, probably a minute to a minute and a half to post a transaction. Organization structure changes. Sometimes what happens, and many times I see this in the budgeting scenario, every time the organization cranks out a new budget, there's a new organization structure. And the big implication here, of course, is that we want to align the reporting to the organization structure that's in place, as well as the budgeting. So organization structure changes sometimes cause the setup to get messy and cause a need to clean it up. There's new integration needs. So we live in a world where new business systems come into play every day, and sometimes when we go to integrate those, we're going to find out that we need a touch point to the core ERP that may or may not exist. Intercompany transactions that interfere with consolidation. Sometimes intercompany's not set up. Sometimes we have multiple companies set up and they're not talking the same language, and just creating a whole bunch of manual headaches around that. Patched reporting across multiple entities. It amazes me today, still today, with all the fantastic tools that ship with Dynamics GP, how many people still rely on Excel-based ad hoc reporting and dropping data into Excel to manipulate financial statements and give organizational stakeholders the information they need. There is a better way, and it's to use the reporting and analysis tools that are available in Dynamics GP, and I think cleaning up the data and restructuring is a big part of that, so we'll talk about that. And of course, multiple companies exist. And sometimes what happens in an organization is, they go out and establish new business in new territories, and they set up new entities. And those entities get set up in GP as separate entities, and at some point they say, oh my goodness, there's been a proliferation of GP companies here, and we need to consolidate them and bring them back together. And that can come into a messy structure and a need for cleanup. So we're going to talk about that today as well and how to handle that situation. Okay, so let's get started here into the content. First, one of the things I see a lot of, and I don't know why, I guess I see this from a finance perspective, and I'm allowed to say that because I've got a finance background. Seems to me that a lot of accountants and a lot of finance people like to structure all of the reporting that they're going to do in the general ledger. It's like the general ledger is going to be the end-all and be-all of our reporting repository for GP. And I'm kind of here to say it shouldn't be that way. In fact, in a best practice scenario, we keep the general ledger really, really clean, and we focus on using the subledgers where all of the rich data is for a lot of the reporting and analysis. So for instance, in our organization, we're a professional services organization, the key value, the key data that we look at comes from project accounting. You know, we have some stuff in the GL. Yeah, we can run, you know, a P&L and a balance sheet and expense analysis and all that other good stuff out of the GL. But if I want to know project profitability, customer profitability, employee utilization, you know, for example, just some of those things. Are we on track or off track? Is the quantity of hours we've spent on an implementation exceeding what we budgeted? Those answers come from the project accounting module. If I was a software company and I was looking at recurring revenue, if I was looking at how we're selling by channel, who our top salespeople are, who our top customers are, what the renewal rates are, all of that type of information I'd be getting out of sales order processing or potentially contract administration under field service. So, you know, those are just a couple examples to say when we look at restructuring, if the outcome is better reporting, if that's what we're chasing, then we need to really balance these two out. We need to say, what's going to be in the GL, where are we going to lean on the GL, and where are we going to lean on the rest of the system? And we want to keep an open mind to that at a high level just as we go into this. So let's talk about why we're cleaning this stuff up. When we go in to clean it up, again, consistency, some reasons here. We want consistency of reporting information across business units. We want to ensure compatibility. We want to ease consolidation. We want to make sure when we go to run a consolidation across multiple entities that the chart of account structure is at least as close as possible. I'm going to say to you that when we're setting up a new system, if we're setting it up in a multi-entity environment, we make sure that all of those entities have the exact same account structure. They may have a different number of accounts, but segment 1 is segment 1 across all the companies. Segment 2, segment 2, segment 3 is segment 3, whatever those segments are. They're the same across those entities, and that is crucial and important when we talk about consolidation. Benchmarking between different business units, areas, and entities. Of course, that's really hard to do if there's no consistency in the structure, right? I mean, we want to make sure that, hey, salaries and benefits falls into the 6,000 series for all of our divisions, all of our departments, all of our entities. So again, consistency is the key here. Reduced learning curve due to commonality. If you're bringing new people into the organization, you know, learning a setup that's consistent and standard across all of the, all of the different entities and within the structure will make things easier for them as well. And reducing time spent on reconciliation procedures. Again, if the structure is clean, if everybody knows the posting accounts, then we can reduce reconciliation procedures. You know, one of my favorite ones to look at when we get into this dirty data stuff and cleaning data up in GP and cleaning up structures, I always go to the account master card. And when I go into the account master card, I click on accounts payable or accounts receivable, which basically every business in the world usually has. And on there, there's a little check mark, okay? It says allow account entry. And if that check mark is selected, it means people can put journal entries to that account. And I always say to the clients, I'm like, but isn't AR and AP the definition of a control account? Like, why would we ever make a journal entry to AR and AP? We shouldn't make journal entries to it. In fact, by default, when we ship GP, that check mark should be taken off. We shouldn't be allowing account entry against AR and AP accounts. And, you know, that's just a simple way to say that if you use the subledgers and you treat those control accounts as control accounts, and you have the process set up correctly, and you have your posting account set up correctly, then you shouldn't need to reconcile it. The AR and AP control accounts should always tie out to the subledger. If they don't, there's something wrong with the structure. It shouldn't be a half day at the end of the month to reconcile AR and AP. The system's way better than that. Something's wrong with the setup. So again, we got to really spend time thinking about things like this, because reconciliation, first of all, it's like the dirtiest dish there is for an accountant, right? It's the last thing we want to do is reconcile. Let the system run, set it up so that it runs, and push the transactions through so that they're clean. Reduce that reconciliation time. You get it right back at the end of the month. You'll love it. All right, so that's another important piece to consider. Built-in flexibility for growth without sacrificing current transaction efficiencies. Yes, I see this all the time when new clients give us a preliminary chart of accounts. You know, they sequence them like 1 digit at a time or 2 digits at a time, and I say, you know, guys, let's sequence them 100 digits at a time. Instead of having a natural segment that's 3 digits long, let's make it 400. Let's have cash as the 1000 series, and maybe AR is the 1100, and you know, prepaids is the 1200, etc. Because I want to allow between 1000 and 1100 lots of options for new bank accounts, and between 1100 and 1200 lots of options if there's additional receivables tracking we need to do, and between 1200 and 1300 lots of options if we have to set up new prepaid accounts. So always think about structure in terms of growth. Also within the system, when we talk about growth, there's things like the level of posting detail we do into the GL. And, you know, for a high transaction volume environment, you know, maybe we don't need to post in detail. Maybe we just need summary level postings. So there's some things like that that we look at as well. Now, the big thing I like to talk about in terms of core structure, and it seems to me after all these years, no matter how many implementations we do and what modules they include, that every path always leads back to the general ledger in GP. And, you know, when we look at that general ledger, we think about the chart of accounts structure, and it is so fundamental to the structure and what we're going to get out of this system. Again, not to say that the GL is the only place we're going to report, because, you know, my paradigm is that I like to go to the subledgers. That being said, the GL is an important part of the structure, and keeping it clean is extremely important. So let's talk about what we have. Right, in GP, we got all sorts of things we can use to classify information. We got this, first of all, this huge segment structure, which would allow you to set up to 10 segments in your chart of accounts, and you could have an account string that could be as long as 66 characters. I'm going to say don't do it. Right away, do not do that. We want to keep it smaller so that it's more concise and easier to manage. There's an account category that's required anytime we set up a GL account. That's fantastic reporting grouping field. We want to think about those categories and use those categories. There's user-defined fields on the account card, and there's also analytical accounting. So let's talk a little bit about how this plays in. We'll show a few screenshots here. You probably know this already, your account format card, you know, your main account maintenance card where it lists out the category and the user-defined fields that are there. You may not know that the category and user-defined fields can be used in Management Reporter as a report grouping level. So great to think about those in terms of combining information for reporting and report groups out of the box. Analytical accounting is another piece that's here. Analytical accounting is something that I really like. I think you have to be careful a little bit how you position it, and I want to talk about that in a minute here. Suffice to say, analytical accounting, when done right, helps us keep the chart of accounts clean. The main advantage of analytical accounting is that I don't have to create a segment in the underlying chart to report on this information. And because I don't create a segment in the underlying chart to report on the information, I'm not going to be stuck with the baggage of that in my chart of accounts if, say, I'm tracking projects and a project ends. Analytical accounting makes it easy to track things, and it really doesn't impact your chart of accounts structure. That's my favorite part of it. And, you know, some of these things, as I just mentioned, they show up in Management Reporter. On the screenshot in front of you, in the first orange bubble on the left side, the class, the account, the sub-account are GL segments. On the right-hand side, you can see the account category, which comes from the GL account card. You can see user-defined field 1's been mapped in here, again from the GL account card. And then we can see consulting revenue by employee and some XYZ column, which are analytical accounting segments. So when we stand and look at this from a financial reporting perspective, the beauty of this is that all of those variables are treated with equal weight in Management Reporter. You know, it's not more important from a reporting perspective that it's a segment or that it's analytical accounting or that it's account group. They're all just treated as options with equal weight in management reporting. And so that's extremely important for us to consider as we look at the structure. So if we're thinking about this, where do we get started with these two items? Let's talk about the chart of account segments and the analytical accounting segments, because usually what people are wondering at this point is, okay, John, that sounds good, but how do I know what to put where? So when we talk about chart of account segments, what we think about here are the things that are not going to change. Let's put it that way. Stuff that's going to stick. Stuff that's going to be here in this organization, and we're going to be reporting on it for the next decade. So we're always going to have a main account. You know, a lot of organizations say, yeah, we're always going to have a department structure. So those are things we like to say. The hard segments should be in the chart of accounts, and the hard segments are the things that don't change. I'm also putting here that I don't go beyond a maximum of 5 segments with anybody. We learned that lesson a long time ago. We had a client that we let go to 7 or 8 segments, and it just became unwieldy and unmanageable. So my maximum's 5, and every time I've seen a chart of accounts structure that has more than 5 segments, it says to me there's something wrong with the structure. Something should be in analytical accounting, something should be in an account category, something's being duplicated here that doesn't make sense. And every single time we've got it back to 3, 4, or 5. My favorite number is probably 3. Not that it matters. Enough digits to allow for growth. Make sure that we space the chart of accounts out. We're going to talk about that in a second. And, you know, we're going to use here dimensions that are not short-term in nature. So again, thinking about things that stick over the long term. The natural will always be there, but then we want to think about things like department, division, business unit. When we talk about analytical accounting, we think about management reporting needs. We think about financial dimensions of information that are short-term in nature or subject to change. So we think a lot about things like this. Marketing initiatives. Maybe somebody wants to track the enormous spend we do on trade shows by trade show. But because the trade show comes and goes, we're tracking expenses against it for a maximum of 3 months, and then we don't do it again. So that's an excellent one for analytical accounting. Another excellent one for analytical accounting are things like projects. If we're just doing cost accumulation against projects, and the projects are short-term in nature, and they're frequently being added to the system, then project would be a great thing to have in analytical accounting. Another one we put in analytical accounting a lot is an employee ID list. Oftentimes I'll hear like, hey, if we want to know travel expenses by employee, and we're not using a travel management system, we're not using project expenses, so how do we do that? Well, you could set up an analytical accounting list, and on certain accounts you could make it mandatory to tag an employee to an expense transaction hitting that account. So again, those are some good things to think about. But the biggest thing here is if it's high frequency subject to change, analytical accounting is where it needs to be structured and where it needs to be housed. Because once you put a transaction against an underlying GL account and against the segments, you're stuck with that baggage. GP won't let you delete it because it's got a transaction against it. So, that's why I think analytical accounting is better for some of these types of financial dimensions that we track. This is another one that comes up all the time. I'm always surprised at this. And I guess it's because when we go to accounting school, we don't get taught, nobody really stands up and says, hey, here's how you should structure a chart of accounts, or at least they didn't when I went. Maybe they do it now. First of all, I think this is actually fairly similar to how Fabricam does the chart of accounts in the sample company that ships with GP. But you can make Management Reporter a lot easier to use. You can make the system a lot easier to understand for employees. We talked about consistency across different entities for consolidation, et cetera. And a structure like this works. I recommend this structure to all of our customers, where the 1000 series is assets, the 2000 is liabilities, 3s are equity, 4s revenue, 5s are cost of goods sold. And then from 6, 7, 8s, and 9s, I usually have 6,000 as being labor-related or people-related stuff, and 7,000 as being, other operating expenses. $8,000 is non-operating expenses like gains and losses on disposal of asset, foreign exchange gain losses, etc. And if you're using unit accounts, I put those down in the 9,000 series. You can take this for what you need, but what's important here is that you come up with a logic to it that applies across your different entities. And it shouldn't just be numbers. The numbers should have some implicit logic in them, right? When we look at them, it should be more. We should say, okay, I know, for instance, if I go to Management Reporter, I can quickly check the balance sheet by doing a row of 1 star, which will grab all my assets, 2 star, which will grab all my liabilities, 3 star, which will grab all my equity. And by the way, since it's mid-year and we haven't run year-end on the balance sheet and I need to bring current year profit in, I could do a row that says show me the value of 4 star to 9 star, 4 star to 8 star, which would give me all my P&L accounts. So again, there's a lot of rationale for just making this, using a structure like this, because it'll really, really help you with reporting especially. And then implicit in the numbering can be some logic as well. So like, I often run into this one, well, we've got divisions and departments. So we have a division for G&A, one for sales and marketing, one for R&D. But we've got departments in those as well. So the question is, do I need 2 segments here? Not necessarily, right? Because if, for instance, I say, well, I'm going to use 1 3-digit segment, and I'm going to say, I just know implicitly that all the 100 series is G&A and all the 200 series is sales and marketing. I don't need to make I don't need to have a 200 and then 200-220, for instance, to get to marketing. I could just have 200 natively rolling up, knowing that the 200 series is sales and marketing. So we think about some implicit logic when we number things. Sequencing is extremely important, and when you set up that chart of accounts in GP, there's a capability where you go in under the company segment setup to type in descriptions for the segments. You want to use that because if you're looking up a segment value in Management Reporter, it reads that. So every time we set up a new account, we want to keep that up to date. And what you'll find is when you go to create a new GL account, the system will automatically give you an account description because it's reading those segment description setups. That's something else I see a lot of customers not keep up to date, and it is really important for the lookups in Management Reporter. So keep those segment descriptions updated as well. Now, that's kind of GL structure. We don't have enough time today, unfortunately, to get into the subledgers. I'd love to do that sometimes because I think there's some really good stuff in some of the GP subledgers. There's a lot of good things you can do with inventory using the inventory user-defined fields and sales order processing using the user-defined fields. There's lots of great stuff in project accounting and some of the other modules there as well. But one of the things that comes up today when we look at overall structure of the system is multiple companies. And we talked about this at the beginning where sometimes what we see in setups is just a proliferation of companies. It could be because of acquisition. It could be because of a strategy to grow the organization in multiple regional jurisdictions, whatever the case may be. And sometimes clients arrive at a situation where they say, gee, we have all these GP companies. Really, we only need them under one umbrella or one roof. Or maybe it's a few roofs. We don't need them. We need a few parent companies. We don't need, all these different companies. And so there is a process we have at CRG with a product called Company Consolidator that allows us to bring together multiple GP companies. And when we do that, what we're going to want to make sure of is that, we clean up the account structure. It allows us then to not have the same master data repeated all over the place. If we bring them all together, we can have one vendor list, one customer list, one item list, for instance. Avoids our users having to log in and out of the system all the time to get between companies. And, it'll help us streamline reporting. So those are some of the issues that we see when we have these multiple companies. Here's a note on the add-ons that can help with both of these issues. So changer and reformatter on the left side deal with the chart of accounts structure, okay? First, let's talk about reformatter. If we design a new chart of account structure, it may involve adding segments or adding segment length to your existing chart. You want to check to make sure that the segment's length hasn't been locked when your system was originally set up. If it's been locked, you'll need reformatter to extend length to it, okay? And reformatter is the only tool out there that can do it. So let's say I had a 2-segment structure that was 6 digits and I found out it was locked. And as a result of watching this and thinking about our structure, I decided, we need to go to 4 segments, and those 4 segments need 14 digits. I would need Reformatter to extend that. Once I've done that, then I can use Changer. And Changer allows us, it's by far the best tool on the market for doing it. I've used it hundreds of times myself. It's the only tool I'll use for this. It absolutely is clean and efficient in terms of dealing with data. And what it does is it lets us renumber, resequence, and merge together the chart of accounts. It will also work for inventory items, customer codes, vendor codes, employee codes, project codes, and all sorts of other things. But if we're talking about the chart of accounts, it's fantastic for using on the account set. And the reason I love it is because I can create out of Smart List an account index with an account number, drop it to Excel, and in column 3 put my new account number, and I can just import that into Changer. I don't have to tell it, what's a numeric number change and what's a merger consolidation. Changer figures that out, and it just runs it on its own, and it runs it faster and more efficiently than anything else that's available. So Changer is a fantastic tool. It has been relied on for years and years and years. It's what got CRG recognized in the channel originally through all the partners. You can ask them about it. It is a very trusted solution and the best one to use for this. Analytical accounting, if you're using analytical accounting, you're thinking about growing analytical accounting, I'm going to tell you something here. We've got a great tool for clients that say, if only I'd known about analytical accounting, I would not have put this stuff in the chart of accounts segment. So with analytical accounting tools, we've got a migration tool here from analytical accounting that allows us to essentially migrate data that's sitting in one of the chart of accounts segments and move it out to analytical accounting. So let's say, I mentioned somebody before who had over 200,000 accounts, and it's because they set up salespeople as a segment in their chart of accounts. And again, according to the structure we're talking about today, that would be a big no-no. We wouldn't advise that. However, the beauty of the analytical accounting tool we have is that it will allow them to take all of the salesperson data that's in that segment and move it to analytical accounting. And then using Changer, they can eliminate the segment. So in fact, what we did is dramatically reduced the chart of accounts 10 or 20 times, and we didn't lose anything because all of that history got moved to analytical accounting. So it's a great tool for doing that. There's also an analytical accounting Changer tool there that's useful too if you've been using analytical accounting for a while and you want to clean it up. Changer is there for AA with us as well. And lastly, the last thing we talked about was I got the proliferation of companies. And here we talk about our company combiner product that does involve some services as well, where essentially what we do with company combiner is we pick a parent company and run a process that brings a bunch of other companies and migrates them under the parent company. And we're seeing a lot of interest in this. One of the larger ones we did recently is we took an organization with 60 different entities in GP and merged them together into one, okay? Now, sometimes we do large amounts of companies into one company. Sometimes the clients keep 3 or 4 different companies, and part of the reason they'll do that, of course, is they may have a need for separate functional currency reporting. So, I mean, that will say, okay, well, we can't have one company. If we've got different functionals, we've got a company for each of the functional currencies. So we do this a number of different ways. And oftentimes with Company Combiner, clients implement a product called multi-entity management from Binary Stream. It's a well-followed product. It essentially lets you create multiple entities in one GP database. And again, the main advantage of the one GP database is that we just don't have the duplication of master data. And it's not just master data, too. It's also processes. Like we're looking at this with somebody right now. I think they've got close to 50 companies, and they got fixed assets in every company. So, the controller has to go in at the end of the month and run the fixed asset depreciation routine and the posting routine 50 different times. Bringing that together into one company has immediate benefits. It's going to save them a huge amount of time. With multi-entity management, they can actually continue to track them as separate companies or separate entities if they want. So if you're in that situation, definitely open your eyes to CRG's Company Combiner product. Lots of experience with this, lots of expertise, lots of case studies and stories we can share with you. And with that, I think we're getting near the end of our presentation. I'll just tell you and remind you that we have some other great solutions. M-Perform, which I mentioned at the beginning, is the only employee performance management product on the market today that integrates directly with Dynamics GP and AX. For those of you who are deep into improving the budgeting and forecasting process in your organization, definitely take a look at Board and Adaptive Insights. We've got lots of great information on that. And if you ever need costing or allocation solutions, CRG has great experience in this area. We have two products we've developed for costing and allocations. CRG's Cost Allocator, which integrates directly with Dynamics GP, as well as our Flex ABM solution, which does activity-based management. Lots of information on these products and free trials available at crgroup.com/products. I encourage you to take a look at the trials that are there, and certainly reach out to us if you have any questions or anything you want more information on. Really appreciate everybody's time. I hope this was helpful for everyone. Love to talk to you more about anything you want to do, and certainly your partners are a great resource for this type of information. I'm sure that all of your existing partners have done these exercises before and can lend a lot of insight to it. Thanks again. We do these from time to time. Come back and take a look at our other ones when we do them. Have a good day, folks.